Hello, hello, hello. Stuart Heath here, founder and CEO of Harvard Grace Capital. Thank you for tuning in to our sixth edition, our sixth part of investment terms that everyone should know. This week we're talking about 5 specific terms, very basic stuff, but if you don't know them, you need to. We're going to talk about stocks, bonds, a fund, options, and dividends. And before I forget, we've got all these put together into a wonderful PDF. And if you'll just go to our website and go to resources, just give us your email address and you'll be able to download that and have it available. There's actually more terms than we're actually covering in the videos. So what's a stock? A stock is a representation of ownership of a corporation. Stocks and shares are generally used synonymously. They're traded as stock, as they say, but you refer to it as I own 10,000 shares, and that's really the same thing. There are multiple kinds of stock. There are common stock, which is generally the most common, but it usually has all the voting rights and governance rights. There's preferred stock, and there can be all kinds of variants of preferred stock, and it will have various different rights and responsibilities, but obligations that go along with it. A preferred stock generally will have some preferences with regards to return and being able to be bought back and things of that nature. Similarly, but functionally quite different, a bond is actually a debt. It's a very specific debt and has very common terms with other bonds. But bonds, if a company issues a bond and the people who buy it are called bond holders, that's a debt. The company owes money to the bond holders. It's not too, there's all kinds of different kinds of debt. There's loans, there's mortgages, there's commercial paper, and other kinds of obligations such as that. A bond is very specific. Generally, they're denominated all identically. And generally, when we talk about bonds, we are talking about publicly traded debt instruments, either corporate or government, municipal bonds or treasury bonds or corporate bonds. Otherwise, companies will generally borrow from a bank or from some other private source. What is a fund? A fund is generally put together by a sponsor that will invest in certain stocks, usually, but they can also invest in bonds. So a fund is a pool of money that they have raised from many different investors, and they will call it the Harvard Grace Opportunity Fund, as example. So you're investing, generally these are called blind funds. They may or may not tell you exactly what they're going to do with it. They may or may not know at the time that you're investing. But then they will take those funds and with their best efforts, buy investments that they think are going to go up in value and then return your assets to you either when you call for them or on a quarterly basis, pay you some profit distributions, or just at the end of the life of the fund. What is an option? Options can be a little tricky. An option is exactly what it says. It is a right to buy a stock at a particular price and within a particular time. So options have price and they have time, and I think it's the third Friday of every month is option expiration day for whichever. So all of the August options for all the different stocks will all expire on the same day, and so you have this what you call time premium, which will affect the price. The option will go up and down based upon the price of the underlying stock. If you're buying Google and it's it's at $1,000 and it goes up to $1,200, your option to buy that Google stock will also go up in value. But the one thing that will also sort of bring it down in value is its time to run out. So you can have options that are, quote, in the money. If Google's $1,200 and you have an option to buy it at $1,000, that option's in the money. Then you have the opposite, where you have options that are out of the money. If you have an option to buy Google at $1,500, but Google's only at $1,200, that option is out of the money. Doesn't mean it's worth less. It's just out of the money at the moment. There are two different kinds of options, there are put options and call options. And a put option is a right to force somebody else to buy the stock from you. And a call option, which is the most common kind, is a right to buy a certain stock at a particular price. We talked about dividends a couple of weeks ago, but a dividend is a distribution of either stock or cash from your stock holding. Usually it's representing cash generated from operations, and your bigger stocks will be paying out dividends every quarter as they become bigger and more stable. A lot of your tech companies don't pay out dividends. That's their choice. Not all companies have to, but a dividend is a distribution from a corporation that you own stock in. So pretty long-winded today. These are some pretty technical topics. Would love to hear your questions. Would love to hop on the phone with you and hear your questions. See if we can't help you out in further your understanding about investing. Thanks for watching.